Hi everyone, in this video we're going to talk about arbitrage on cryptocurrency futures and BitSpreader as a tool for executing the arbitrage trades on cryptocurrency futures. Term arbitrage describes a trading strategy in which a trader profits from price differences of the same asset. In its simplest form, due to the decentralized nature of the cryptocurrency markets, there are situations in which we can see price differences between the exchanges and we can buy Bitcoin on one exchange and at the same time sell it with a slightly higher price on another. Of course, the execution of this transaction is not as simple as it sounds. BitSpreader is a futures spread trading platform, and as spread trading is a superset of arbitrage, we can use BitSpreader for arbitrage trading. Investopedia, in its futures spread trading strategy definition, describes it as an arbitrage technique. It can be arguable if trading on the spread between two futures with different delivery dates is an arbitrage, but definitely trading on the spread between two future contracts with the same delivery dates on different exchanges is an arbitrage. Let's take a closer look at it. How to set up arbitrage trade in BitSpreader. In short, we can arbitrage on futures with the same delivery dates or on perpetual contracts. At the right moment, when the price difference, the spread, is the lowest, we buy the spread. That means we buy one contract and sell another. Then we wait until the spread grows. The prices go as far one from another as possible and we sell the spread. That means we sell the first contract and we buy the second. Let's go and let's choose coin margin futures. Now let's select Deribit perpetual contract as leg 1 and Binance perpetual as leg 2. Here we can see the spread chart. This spread chart expresses the price difference between the perpetual contracts on Deribit and Binance. As you can see, it's not zero. All the time the price difference fluctuates. It is far from being stable. The price difference moves in a pretty narrow channel. In fact, it is almost always positive, which tells us that the price of the perpetual contracts on Deribit is always minimally higher than the price of the perpetual contract on Binance. How to execute the arbitrage trade? We first need to buy the spread. That means we need to buy the Deribit perpetual contract and sell Binance perpetual contract at the same time. This is what BitSpreader does for you. It executes two trades simultaneously. The best moment for buying this spread is when the spread price is the lowest. We must switch the price to the ask price to see the historical values of the price for which we could buy this spread. As the spread price is a price difference between Deribit and Binance, the best moment to buy the spread is when the price on Binance gets as close as possible or even becomes greater than the price on Deribit. Let's note what are the lowest levels. Let's switch to 1 hour candles. We can see that the spread ask price sometimes goes to as low as -5, sometimes even to -10 or lower. In the next step, we need to understand what will be the price of the spread when we sell it. Selling the spread means selling Deribit perpetual contract and buying Binance perpetual contract. Let's switch the chart to show bid price candles. At its highest values in the last hours, we could sell the spread for $30, $40 or even $120. Now let's do the math. For the spread trade size of 1 BTC, buying for -$10 and selling for $40 gives us $50 profit. We still need to pay the exchange trading fees. There are two major factors that decide about the profitability of arbitrage trades: speed and the fees, and we will get back to this in a second. One important note about the amount of the spread trade. 1 BTC is the nominal value of each spread trade leg. As we are trading on the futures contracts, we trade with the leverage. Deribit's default leverage is 50. That means that to trade 1 BTC, we need 0.02 BTC. What with the current value of BTC close to $20,000 is $400 as a margin for a single spread trade leg and $800 for both legs. In case we could execute our arbitrage trade with the profit of $50 while engaging $800, that would mean incredibly high return on a single trade with no risk involved. But we have not calculated the trading fees yet. Let's consider executing this arbitrage trade with the auto-trigger order. BitSpreader executes auto-trigger order when the spread price reaches the trigger price provided by the user. For buy orders, BitSpreader executes the order when the spread ask price goes below the trigger price. For sell orders, BitSpreader executes the order when the spread bid price goes above the trigger price. When triggered, BitSpreader executes 2 market orders simultaneously. Buying the spread means executing 2 market orders. Selling the spread means 2 more market orders. For each market order, we pay the taker fee. In the basic level fee tier, Binance has 0.04% taker fee and Deribit has 0.05% taker fee. For all the trades together, we would pay 0.18% fee. As the prices analyzed earlier refers to 1 BTC is around $20,300, 0.18% is $35.5. After subtracting this from our profit, that is $50, we are still at a profit of $13.5. Not bad. The question is, will the auto trigger be able to catch these spikes in price? The spikes in price that we have observed may be very short-lasting. In order to execute the auto trigger order, BitSpreader first needs to receive the message from the exchange about current levels in the order books. It needs to compute the difference and, in case the triggering condition is met, call the exchanges again to issue 2 market orders. There is a latency involved that can cause a slippage. By the nature of the market orders, they will be realized by the exchange with what is available in the order books. As the order books may change between the moment when BitSpreader observed the triggering condition and the moment of market order execution, we may encounter the slippage. Actual price for which we buy the spread may be different from the triggering price. The risk of the slippage grows if we want to catch very short bursts of price with the auto trigger orders. We may sometimes even end up with the loss, as the fees for the trades exceed the profit. As the alternative scenario, let's consider executing this arbitrage trade with the auto spreading order. BitSpreader executes auto spreading orders with use of 1 market order and 1 limit order. First, we choose on which market BitSpreader will be placing the limit orders, the quoting market, and on which BitSpreader will be placing market orders, the hedging market. BitSpreader puts a limit order on the quoting market with the price that is computed as the price on the hedging market plus provided spread price. Every time the hedging price moves, BitSpreader updates the limit order. When the limit order is filled, BitSpreader instantly hedges by executing opposite market order on the hedging market. This approach is much faster. On one side of the spread trade, we use the exchange mechanism to match our limit order. The probability of the high slippage is significantly reduced, however the slippage is still possible. Also, the fees are much lower. On Deribit, the maker fee for limit orders is 0%. On Binance, in basic fee tier, it is 0.02%. In total, the fees for the spread trade made with the use of auto spreading orders will be 0.11%. That is $22.3. What with the less latency in auto spreading increases the chances for the profitable arbitrage trade. To sum up, cross-exchange arbitrage on cryptocurrency futures is possible and can be profitable. 2 approaches that we have described are with use of market orders, overall looks well, but the latency and fees can reduce our profits, or with the use of limit orders, method that is much faster and has lower fees. Both methods are available in BitSpreader. We invite you to try them out. And that's it for today. Thank you for watching.